Welcome back to your Mortgage Minute. We have our mortgage expert Mouli here to help answer our questions. If a buyer got pre-approved 3 months ago and suddenly the numbers do not work anymore, what changed? The market, the lender, or the plan? Mouli, can you answer this question for us?
Usually the plan changed first. In 2026, the Bank of Canada is holding the policy rate at 2.25%. The stress test still screens borrowers at the higher qualifying rate, and affordability in markets like Toronto and Milton is tight enough that a small shift in income, debt, or down payment can knock a file off the rails. A pre-approval is not a finish line. It is a snapshot.
So when we say reset, what does that mean in practical terms for a buyer?
It means rebuilding the approval around the current facts instead of treating the old certificate like it is permanent. First, check whether the pre-approval expired. Second, rerun the file using the current rate, current debt load, and current down payment. Third, decide whether the buyer needs more room from the FHSA, the home buyer's plan, or a different property price point. Take a simple example. If a buyer planned on a $600,000 purchase with 5% down, the down payment is $30,000. If the lender now approves only $570,000, the buyer is short by $30,000 on the purchase budget, even before closing costs. That is not a rate problem. It is a capacity problem.
Give me the math on how those tools change the picture.
Sure, the FHSA allows $8,000 of annual contributions with a $40,000 lifetime maximum, and the home buyer's plan currently allows a withdrawal of up to $60,000 from RRSPs. If a buyer has $32,000 in FHSA room over 4 years and also uses $60,000 from RRSPs, that is $92,000 of assisted down payment capital before any family gift or savings from cash flow.
Can you give another example to explain this?
Here is the second example. On a $500,000 home with 5% down, the minimum down payment is $25,000. Add roughly 2% to 4% for closing costs, and the buyer needs another $10,000 to $20,000 on top of that just to close comfortably. If the buyer only saved $30,000 total, the deal is already fragile.
What should listeners watch out for when they are trying to stretch the file?
Red flag. Extending amortization or forcing the budget up just to preserve a house price can create a long-term payment trap. The file may pass today, but the borrower can end up house rich and cash poor. Another red flag is assuming a lender will keep the same approval after a job change, new debt, or credit score drop. Pre-approvals can weaken fast because the borrower profile is dynamic.
How do you decide whether to push forward, pause, or change the target?
Use a 3-part decision framework. 1. If the buyer is within about 5% of the needed budget, a reset is usually worth it because small fixes can close the gap. 2. If the gap is larger than that, the buyer should either increase savings or lower the target price. 3. If the file depends on perfect timing, it is too fragile and needs a cleaner structure before shopping again.
Can you give one more concrete scenario?
Absolutely. Suppose a couple wants a $700,000 home. At 5% down, they need $35,000 for the minimum down payment, plus closing costs that could add $14,000 to $28,000. If they only have $45,000 available, the deal is short by $4,000 to $18,000 before moving costs. In that case, the reset conversation is not about can we squeeze a little more, it is about whether FHSA contributions, RRSP withdrawals, or a lower target price create a safer path.
So the takeaway is not wait for rates. It is rebuild the plan?
Correct. Buyers do not need a perfect market. They need a file that survives the stress test, a down payment plan that includes closing costs, and a target price that fits the real approval. If they can fix those 3 things, the market gets a lot less intimidating.
That is the reset listeners need to hear. Thanks for joining us on your Mortgage Minute by onlendhub.ca.